Welcome back to the Talking Hedge, your cannabis business podcast. I'm Josh Kincaid. After a strong January and February, the cannabis sector put one of its worst weekly performances in 2019 last week. The broader equities market declined after a weak jobs report. The S&P 500 reported its first weekly drop since January. Investors should properly reduce their risk exposure, for example, cannabis stocks, as uncertainty remains high in the market. Cannabis stocks followed the broader equities market down last week. Horizon's Marijuana Life Sciences Index ETF lost 2.6%, and ETFMG Alternative Harvest dropped 3.9% last week. The large cap performances were influenced by Jefferies and Cohen initiating coverage on several stocks. Tilray dropped 12% after Jefferies initiated with an underperformance rating and a $61 target price. Aurora gained 5.6% after Cohen called it a top pick with a $14 price target. And Cronos was flat after it closed the $2.4 billion investment from Altria, parent company of Philip Morris, who is officially in the game as the largest shareholder of Cronos. Aphria was down 5.8% despite becoming a fully licensed as its entire Aphria One facility, and Canopy dropped 3.5% without any major news. Unlike other industries you've invested in, cannabis is rife with scale-inhibiting regulations, founders with potential black marks on their records, and a change rate that can leave portfolio companies in the dust. Make sure to do your due diligence on your fund of choice. Everybody seems to be jumping out of the woodworks wanting to invest in cannabis, so if you're interested in profiting from pot, you can consider an exchange-traded fund or ETF versus individual stocks. ETFs pull together money from many investors so that you can own many stocks. Therefore, an ETF provides a simple way to gain a broad exposure to pot stocks. However, ETFs do have drawbacks. Marijuana ETFs must be bought through a broker, so you pay a commission each time you buy or sell. Also, you'll pay annual fees, usually expressed as a percentage of assets to the company managing the ETF. Furthermore, ETFs can buy or sell stocks more frequently than you might want, causing unexpected capital gains taxes. ETFs give you more diversification, but individual stocks allow you to invest in the companies in which you want the most interest. If you hold your stocks for longer than 1 year, buying individual stocks can limit your capital gains taxes too. And you won't pay a management fee if you buy individual stocks on your own, but you'll still pay commissions when you buy and sell individual stocks. And the risk can be great if you invest in a stock that drops. Your loss is a lot more if you lose money. Think about it. If you invest $1 and the stock market drops 50%, you're left with 50 cents. But if the stock market goes back up 50%, you still only have 75 cents. Something to think about. Investors should also know that most cannabis stocks don't trade on the major U.S. stock exchanges. Marijuana companies listed on major exchanges can't do business where it's illegal at the federal level. So cannabis companies are either avoiding the U.S. market or choosing to hold off on listing their shares on the New York Stock Exchange or NASDAQ. As a result, the company you might want to buy could be listed at the less regulated over-the-counter or OTC market, or it might be available on foreign exchange such as the Toronto Stock Exchange. OTC stocks aren't subject to the same strict financial requirements as stocks listed on other major exchanges. OTC stocks can be volatile because of limited trading volume and narrow price transparency. You may have to get special permissions from your brokerage to buy foreign stocks, and trading them means accepting currency exchange risks that can take a bite out of your profit. Typically, if a stock is 5 digits and ends in F, it's an ADR or an American Depository Receipt. So 5 digits ending in F means that it's probably not DTC eligible. Depository Trust and Clearing Corp is what makes transfer of stocks happen much more quickly. And so if you can't use electronic transfer for settlement, you literally have to do a paper physical settlement. And that's going to cost $75 on the buy and sell side. So if you buy a penny stock, it might cost you $150. Most brokerage firms are going to set that to block, or if they missed it, it's set to real-time sell, which means if you do have it, you can only sell it. You can't buy more of it. Companies that are on the OTC and don't file appropriately are going to have a caveat emptor or a buyer beware stamped on them because you don't have that transparency. But in other regards, even if you are on the up and up, you're not going to have your stock available to buy and sell, which is going to drastically reduce your volume. Without volume, you can't increase your market cap, and that velocity of money stops. And so you kind of need that train to keep going. So it's kind of important to be DTC eligible and off the OTC because the larger exchanges have a lot more credibility, essentially. That said, this drawback may become less of a problem for individual stock investors in the future. A handful of companies targeting the cannabis market outside the US listed their shares on the New York Stock Exchange or NASDAQ in 2018, and more companies could follow suit, especially if they focus on hemp, which is no longer a Schedule I substance in the US. Despite the size of the opportunity associated with the legalizing $150 billion in global cannabis sales, marijuana investing isn't for the faint of heart. The industry is only now emerging, and many of the companies angling for market share today may wind up falling shy of the sky-high predictions, or worse, going bankrupt. Nevertheless, the potential here is significant enough to warrant investors' attention. Just make sure you're willing to do your homework. You want to thoroughly understand the industry and the companies you're interested in owning before you buy. Cannabis can be a lucrative industry if you invest correctly, so which stocks are right for you? Let's take a deeper look and see if you're ready to dip your toes in the cannabis market. The cannabis industry has been on the rise for years, and according to many experts, the industry is poised for another huge year in 2019 and could be worth $147 billion by 2025. Even parts of the industry that currently have more potential than actual real-world applications like CBD-infused drinks have attracted the attention of industry giants like Coca-Cola and Pepsi, and predicted the $600 million market by 2022. Big Tobacco is even invested in the cannabis market, with Marlboro's parent company Altria pumping a massive $1.8 billion investment into Cronos Group, a Canadian company that focuses on rare cannabinoids. Obviously, the market is looking bright, very, very profitable for those smart enough to invest now. So which types of cannabis stocks is right for you? When it comes to cannabis stocks, there's three major categories you want to consider before investing. You want to keep in mind that sometimes subtle and important differences between them. For growers, the first are growers, probably the most simple and straightforward of the three. Unsurprisingly, growers are companies that cultivate the cannabis itself from seed to sale, then either sell directly to consumers or wholesale to other cannabis businesses for use in their products. Due to factors like the continued federal illegality of cannabis in the United States, the ceiling on US companies is much lower than companies in Canada, for example, where recreational cannabis is legal nationwide. Cannabis Growth is the biggest player in this space, boasting a massive market cap of more than $15 billion. They're the leading supplier of medical cannabis in Canada and have positioned themselves as a major player in Germany after they approved medical cannabis. While cannabis is a great option if you're looking to invest, most of the stocks in the grower category rely on the continued march towards full legalization. If that were too slow for any reason due to the administrative change or some other unforeseen issues, investors might be stuck between a rock and a hard place on this one. If the current trend towards full legalization in the very near future does continue, however, it's worth buying into the grower now. When legalization comes, they'll be experiencing a historic boom. In biotechs, there's companies you hear about that are leading the research into cannabinoids and working to find medical links between cannabis industry and pharmaceuticals. These companies frequently work with synthetic derivatives of the organic compounds found in cannabis for treatments of all types of diseases and pain management. The momentum of cannabis as medicine, particularly as a viable solution to opiates, is undeniable, and there's so much potential for investors in this space. A major player in the cannabinoid industry is the British company GW Pharmaceuticals, a company with cannabinoid products that are already out on the market and a massive market cap of $5.2 billion. That huge valuation comes from the potential of an FDA-approved CBD-based prescription drug called Epidiolex, which can be used to treat two rare, severe forms of epilepsy in children. And I also heard it's $35,000. While Epidiolex may have gotten FDA approval, there are outliners. Generally, obtaining FDA approval is a massive stumbling block when it comes to cannabinoid research. It's hard for companies to study and produce innovation in CBD space while funding is difficult to come by due to federal illegality. And just like the previous entry on the list, a major factor in the success of cannabis biotech companies is the progressive march towards full legalization. For investors, it's a non-brainer to invest in an alternative to the destructive and addictive opiates that so many Americans use for pain management that could easily be handled by CBD-based products. Ancillary industries, which is the last type of stock that you can buy, isn't a part of the cannabis industry itself, but all of the products that supplement and support the industry. So for example, WikiLeaf is a tech company that doesn't touch any aspect of the plant whatsoever. Instead, they help consumers to learn about cannabis, find dispensaries and strains near them. Other ancillary businesses includes all of the things that you actually need to grow cannabis. After all, cannabis is just another plant, so it needs soil, fertilizers, pest control methods, watering systems, and light sources to grow, especially for massive grows and farms all over the country. A surprisingly aggressive big name in this space is Scott's Miracle-Gro. Yeah, the same company that puts ads all over the airwaves about fixing up your lawn, and also the company that's buying up small cannabis hydroponic companies. Those aggressive acquisitions are likely to ensure their subsidiary company, Hawthorne Gardening Company, as a leader in the hydroponic space and the preferred choice of cannabis retailers for supplies. While Miracle-Gro might not be the first company that comes to mind when you think about cannabis stocks, it's a relatively low-risk investment to buy into because of how high profit and profitability the company already is, while also having an incredible upside if full federal legalization were to come out. Sometimes the best investments are the least obvious ones that might want to fly under the radar with high-profile investors. So is now a good time to buy into cannabis stocks? While the cannabis industry is looking like it's about to blast off into the stratosphere financially, investors should keep in mind that there's some risk associated with it. While the industry as a whole is highly dependent on federal government scheduling changes and legalization, as well as supply and demand issues that have plagued both Canada and states like Oregon, there's no better time to invest in cannabis stocks than the present. The global demand for cannabis is changing, and a wide majority of Americans approve for full recreational use. As more and more countries with large populations like Canada go full recreational legal and approved for medical cannabis like Germany and the UK, the more money gets pumped into the global cannabis industry. With more states on the way to legalize in 2019, the domestic market in the US will undoubtedly grow as well. The future is looking bright for the budding cannabis industry, their stock, and their investors. Canada became the first major world economy and the second country after Uruguay to legalize recreational cannabis last October. Cannabis is getting official approval from many US states for recreational use in addition to medical usages. Though pot remains entirely illegal at the federal level, Michigan approved a ballot measure during the midterm elections for recreational use of cannabis to become the 10th state, while Missouri and Utah approved for legalization of medical marijuana. The total number of U.S. states greenlighting medical cannabis is now 33. As an evidence of strong demand in the U.S., pot companies have engaged in deals of late. Harvest Health and Recreation is acquiring closely held Chicago-based Verano Holdings for about $850 million in the largest U.S. pot deal, as reported by Bloomberg. The joint entity will have license to operate up to 200 facilities in 16 states and territories, including 123 retail dispensaries. This will make it one of the largest multi-state operators in the U.S., and the deal would allow Harvest to have more than 70 operating dispensaries, 13 cultivation facilities, and 13 manufacturing facilities by the end of 2019. If completed, the acquisition will mark the largest deal between two U.S.-focused pot companies, according to data compiled by Bloomberg. Notably, Harvest is the third largest U.S. cannabis firm. These aren't the first U.S. companies that are engaging in an M&A deal. In November, California-based cannabis retailer and producer MedMen had agreed to buy Chicago-based PharmaCann, a medical marijuana company, for $682 million. The idea is to grab land fast and have licenses to cultivate cannabis. Aurora Cannabis did the same thing in Canada and making several acquisitions in a short span. The idea behind this is to take the Canadian public marketplace and bring that cash back to the U.S. before legalization happens so that they can get those valuations at the lowest point possible while it's still quasi-illegal. State by state, it's legal, of course, and then federally, it's not. So that's why I say quasi. So all of these Canadian companies are legally coming in, buying hemp farms so that they can have their property, plant, and equipment and utilize 280E, which is a tax provision not allowed by cannabis companies. Hemp companies can do that. So while these companies are coming in from Canada and buying up hemp companies, they'll be able to fully utilize all the tax write-offs. So in the eventuality that cannabis becomes legal, they can flip that over into THC facilities and start working across the country. Multi-state operators are the number one form of investment. Companies are wanting vertically integrated operations, so producers, processors, and retailers to be in multiple states. The second driving investment vehicle is data, and then behind that is consumption lounges or cannabis cafes, which are still not widely legal yet, and a Class C felony in Washington. And with that, we're going to roll this one up. If you want to like and subscribe and share, please do. If not, I'm out.